Hey everyone, welcome back to the channel. In my most recent video, I talked about the very recent news that Pershing Square Tontine Holdings, the largest SPAC ever created, is currently in serious talks and is getting very close to a deal with Universal Music Group to complete this SPAC merger. But it's not actually a merger, and I want to talk a little bit more about the structure of the deal and whether Pershing Square is actually getting a good deal here, and if Pershing Square Tontine Holdings shareholders are getting a good deal. If you want to check out that video where I go over some of the higher level details of this SPAC deal, definitely check out the video in the description below. That's the one from a few days ago if you haven't already seen it. Of course, it goes without saying that none of this should be taken as financial advice, and you should do your own research before investing in anything, since everyone's risk tolerance is definitely different. But the shorthand summary of it is that Pershing Square Tontine Holdings is acquiring 10% of Universal Music Group, but then the rest of that money is going into some different places. That's what gets really complicated with this deal. And I want to go over an article that was actually sent to me by Investing with Frank. Go check out his channel if you haven't already. We've done some collaborations in the past, and we are both on Punch Card Investing, the weekly live stream about value investing that we do every single week. But the article is by Andrew Walker, who is a value investor himself. He has a value investing blog as well, and this article is from that blog. So let's go ahead and take a look at that. Yet Another Value Blog is the name of his blog. But the title of this article, breaking down the ridiculously complex Pershing Square Tontine Holdings UMG transaction. Because this deal definitely is complex. It is not a simple one-to-one merger where Pershing Square is just taking over UMG or something like that, or merging into it. This is definitely not a particularly straightforward deal, and we are missing quite a few details still, and technically this could be subject to serious changes in the coming future if this deal actually does go through, since it is not finalized yet. They still have to get to the closing table and get through all this process. But I'd imagine that they are very close to this deal, otherwise they wouldn't be announcing it, so it should be something like this, I would imagine, but time will tell. But if we start going through this article, we can see that Walker puts together a nice bullet point summary, but as you'll see, the bullet points themselves can get kind of complicated at times because this is a complicated deal. He does a pretty good job at distilling this down into more digestible terms, but still it can be a lot to try and figure out because there's a lot of moving parts in this deal. But as he summarizes, for Vivendi, which is the holding company for Universal Music Group, he says that their minority shareholders were going to get hit with a huge tax for spinning off UMG, so selling a position to Pershing Square Tontine Holdings lets them dodge that tax liability. So that's some value that they're getting and why they wouldn't just go public themselves, because apparently they were planning on doing that and doing a spin-off with UMG anyways. So they aren't going to be doing that now if this deal goes through, of course, and that's why they've committed to it. Apparently, this is some of the value that they're getting. So as a Vivendi shareholder, a Vivendi business perspective, that's the value that they're getting by doing this SPAC deal. Plus, they get Bill Ackman on the board, and he is very well connected and generally has a pretty strong reputation in Wall Street and in the business world. Granted, he has had his share of blunders.
Hell is coming.
But overall, I think he has a very positive reputation across the board. Now, what about for Pershing Square Tontine Holdings, the SPAC holders? He says this is a reasonably attractive deal in that they're getting a slice of UMG, which is overall a pretty good business. I'm not really sure on the valuation yet. He's saying that they're being sold for 21 times EBITDA. Walker says that's a better deal since Warner sells for about 20 times EBITDA, and he argues that UMG should be more in the 25 to 28 EBITDA range, assuming that WMG is trading for a fair value at the 20 times. And he argues that UMG is more appropriately priced at 25 to 28 times EBITDA compared to WMG's 20. So that's debatable. Obviously, beauty's in the eye of the beholder. Depends on what your risk tolerance is, but that's a decent bullish case on how Pershing Square Tontine Holdings shareholders could be getting a good deal on the UMG price. And he mentioned some of their tailwinds as a business. You could say that UMG is a dominant business with great revenue visibility, very long-lived cash flows, and basically no capital intensity, no high debt or something like that. They also have a tailwind from most of the trends in society markets right now because, for example, TikTok videos, every time their song is used, a UMG song, they get a royalty. So there's new revenue streams coming in potentially, and they're on the right side of that trend. So theoretically, they're getting a very good business here. But what about the sponsor of Pershing Square Tontine Holdings? That is Pershing Square Holdings, the hedge fund run by our very own Bill Ackman. What's their immediate benefit out of a deal like this? Well, he talks more about the reputation that Ackman has built. In 2020, the fund performance was spectacular, in large part thanks to the credit default swaps that he bought right before the huge dip we had in March, and he used that money to go out and buy many of his favorite companies in his fund. So the performance was fantastic in 2020, and then he started the SPAC. But of course, in order to keep that reputation going as a great capital allocator, you got to allocate the capital at some point, but ideally not into a pump and dump type stock, and instead put it into something that has long-term stable cash flows, the ability to grow those cash flows. And UMG certainly seems to fit that bill, so he's not tarnishing his reputation there, and he seems to be getting it at a reasonable price. So his reputation seems to be preserved, if not even benefiting from it. But there's a lot more ways that Pershing Square benefits from this deal structure than just solely reputation, and that mainly gets into the warrants and the Pershing Square Remainco that's going to be coming out of this deal. So let's move on down through the summary. He writes, more importantly, Pershing Square Tontine Holdings will have some cash left over, which will go to Pershing Square Tontine Holdings Remainco, which is going to be a new entity that spins out of this deal. Pershing Square Tontine Holdings Remainco, I'll just call it Remainco from now on, will effectively be a cash shell, wow, that's actually kind of hard to say, with no liquidation date. So it's not really a SPAC, it's just a shell entity that has a bunch of cash in it, but there's no date attached to it. And that's a key consideration, since Pershing Square Tontine Holdings had a 2-year deadline to make a deal happen. And granted, they still have to finish this deal. So if they do finish the deal, it'll be within the 2-year deadline that he had set out with the SPAC, so he doesn't have to return all that money to shareholders. And instead, what he's doing, essentially, if this structure is allowed to happen, which is another concern, might not be allowed to happen, is he's pivoting the cash he's not using into a sort of permanent vehicle to where it's always going to be there until he uses it. There's no liquidation date that he has to worry about. Because like I said, Remainco is not a SPAC. It's actually just going to be a standalone corporation, it sounds like, if everything goes according to plan. But the SEC might put a stop to that. And getting into some of that complexity, that's what most of the rest of this article talks about. This is one of the most complicated deals I've ever seen, says Andrew Walker. Between Pershing Square Tontine Holdings options chain and the fact that VIV, which is Vivendi, which owns UMG, is publicly traded, I'm positive there are some really interesting trades that could be made from the first people to figure out the complexities of this trade, which is why people are trying to figure it out. But again, we're missing some details. We don't know the exact details with the warrant arrangement that I mentioned in the previous video, for example, since there are layers to this deal and each layer has its own set of its own complexities. That's what makes this so hard. And Walker does his best to do a bullet point summary of the deal. That's coming off of the press release, which was supposed to be a summary in itself, but again, it was kind of hard to understand everything there, so he tried to distill it even further. But again, just look at how many bullets there are. He points it out in the article that this is a pretty long bullet point summary for something that you would think would be pretty simple, because it's not simple. Anyways, Pershing Square Holdings will buy $1.6 billion of Pershing Square Tontine Holdings. They have all these forward purchase agreements that allow them to purchase large shares of Pershing Square Tontine Holdings, so they get a nice chunk out of the deal, which was one of the big advantages to being a Pershing Square shareholder, in my humble opinion, since there was a lot of value caked in there, I think, and technically is still caked in there because the deal hasn't actually finished, and if it does, Pershing Square Holdings gets a big chunk of the SPAC. But UMG is getting $4.1 billion out of about the $5.6 billion from the SPAC, and that's to get 10% of the business. So that's about 73% of the SPAC's cash, which means you got quite a bit left over. So Pershing Square Holdings' share of that, so the hedge fund share, is $1.2 billion, while minority/core Pershing Square Tontine Holdings share was $2.9 billion. So the SPAC itself is getting $2.9 billion of the $4.1, and then the remaining $1.2 is going to Pershing Square Holdings. So that's how the share of the UMG chunk is being split up. Pershing Square Tontine Holdings will hold on to the UMG shares and then distribute them accordingly to the Pershing Square Tontine Holdings shareholders. That much makes sense. That's the simplest part of this deal. And if for some reason the SPAC shareholders don't want to go forward with this deal, they can redeem their shares for $20 per share as sort of a refund. But right now it's trading above $20, so it doesn't make a whole lot of sense unless you just really hate this deal and think you're going to be paying a huge premium and you're going to lose out. So there's plenty of considerations there. Though frankly, right now it would make more sense to sell the share on the open market if you really just wanted to dump it, because you can get more than $20 at the moment. But if you decide to move forward with the deal, then you'll get a proportion of your Pershing Square Tontine Holdings share split into two things. One of those is the UMG shares themselves, and another would be the share of Remainco, and that's proportional to the amount of money that Pershing Square Tontine Holdings is investing into UMG versus what it's keeping for Remainco. But in addition to those two things, you also get a 5-year right called a SPAR that will trade on the New York Stock Exchange to then actually have an exercisable right to invest in a future deal. We'll get back to that SPAR arrangement, that special purpose acquisition right. So we'll get back to that in a second because that's its own can of worms. But for the warrant holders for Pershing Square Tontine Holdings, that's a big thing that Pershing Square Holdings, the hedge fund, has. They have a bunch of warrants for Pershing Square Tontine Holdings. That's actually being pivoted towards the Remainco. And those warrants will not be able to be used towards UMG shares. So it's kind of interesting that the warrants are basically being pointed in a different direction. At least that's my understanding. And instead, you have to use them towards that as opposed to using them towards UMG, because this isn't technically a merger that we would have expected in the traditional SPAC sense. And Pershing Square hasn't released the details for an exchange offer for those warrants. If you don't want to go forward with this, you can actually exchange the warrants for some value, and they'll have more details on what the alternatives are pretty soon, I would think. But back to the SPAR, or the Special Purpose Acquisition Rights Company. So the SPARC is really what it is. That's going to be the third thing. You get an exercisable right to this SPARC. So for everyone who doesn't redeem, who doesn't refund their shares, essentially, you're going to get a 5-year exercisable right to the SPARC. A SPARC is a right that will trade on the New York Stock Exchange. Like I said, Ackman will try to find a deal, and he'll bring the deal to the SPARC shareholders. If those shareholders like it, they can exercise their right and buy into the deal effectively at cost. If they don't like the deal, they can sell their rights or just let them expire worthless. So it really behaves much like a traditional option. You have the option, but not the obligation, to purchase something at a particular price, I would guess. If all SPARCs are exercised, the SPARC would raise $5.6 billion, plus Pershing Square, the hedge fund, has committed to buy $1 to $5 billion of whatever deal the SPARC announces. So assuming all SPARCs exercise, which he says is a big assumption because it obviously is. Not everyone's going to like the deal, but however much bleeds off, you're still going to have many billions of dollars, it would seem. SPARC will have $6.6 to $10.6 billion to offer a potential merger partner. So that's almost like a super SPAC compared to what Pershing Square Tontine Holdings was. Tontine Holdings was at, we just saw, about $5.6 billion once Pershing Square added its cash to the pile. This is even bigger than that, potentially double that, to do another merger in the future. So this is getting that sort of capital allocation reputation rolling into bigger and bigger deals potentially for Ackman's future. And if this deal both goes through and is allowed to stand, it would seem to bode quite well for Pershing Square Holdings as a hedge fund, since now they have this huge extra pile of liquidity that they can tap into to make bigger and bigger acquisitions, or even many small acquisitions. It would depend on how it's exactly structured. But the point is, they got a bunch of cash there that doesn't necessarily have as many of the limitations as a traditional SPAC, and that's through two vehicles. You have both Remainco and this SPARC, so you have two separate ways to do new deals. But Walker is appropriately skeptical. He talks about how the SEC rejected a somewhat similar structure earlier this year when they turned down a spinning eagle SPAC, mainly where the SPAC would move its cash into another cash entity, but maybe remove many of the restrictions or limitations that the original SPAC had. So it's kind of like gaming the system, it would seem. But you could definitely argue, and we saw in the press release, that Pershing Square Tontine Holdings, if they finish this deal, will have completed an acquisition essentially. So they really should be allowed to remove their SPAC status and can do whatever else they want with the rest of the money. That's kind of the argument it seems like they're going to make, and we'll see if that stands, since they did technically find a target, and if they go through with it, that's their acquisition. Now, it wasn't a full-on merger like you might have expected, but it was something. It's not as though they immediately just moved it into Remainco or something like that to get around restrictions. We'll see what the SEC says about that, and we'll also see what they say about that SPARC arrangement, because that is an interesting one and could be a very big piece for Pershing Square as a hedge fund in the future. But the last thing I'll highlight in Walker's article is that the real opportunity here might be in Remainco and the SPARC, and I would tend to agree based on what we know, at least. Remember, Ackman has an absolutely incredible track record of deploying cash in times of crisis, and both Remainco, which seems to have no end or liquidation date, and SPARC, a 5-year SPARC with the potential for extensions, give him a bunch of permanent cash to deploy in a crisis. Pershing Square will own 29% of Remainco, and Remainco will have about $1.5 billion in cash, so Pershing Square, the hedge fund, will have about $435 million of that cash in its own name, as well as a forward purchase agreement that gives them the right to buy another $1.4 billion of Remainco, so those warrants are moving into that, so they're not losing that value there. Pershing Square will be committing at least $1 billion to SPARC, plus getting convertible preferred shares that will give them more upside, and the treatment of the sponsored direct warrants on original Pershing Square Tontine Holdings is unclear, but might just transfer to Remainco. That's my understanding as well. But Walker points out that the incentives might be moving away from this actual target of UMG and will instead be moving maybe towards those other cash entities, the SPARC and Remainco instead, which is good and bad depending on who you are. But he says that Pershing Square could probably get away with this since UMG is a reasonably steady business with great cash flows, and Pershing Square Holdings can put $1.2 billion into them and sleep really well at night, and then they can go look for even better deals with the rest of their Remainco and SPARC exposure, since they'll still have all that liquidity, and they shouldn't have to babysit UMG too much, one would think. Though, we'll see, because they still got to close the deal. If you're interested in learning more about this deal, definitely go check out that article. I'll go ahead and include a link to it in the description below. It is a deep dive on some of the incentives, and I definitely highlighted a good chunk of it, but I left some details out, so be sure to check it out. In any event, I hope this video was helpful for learning more about this Pershing Square Tontine Holdings deal. We're getting more information as we move through time, since they are actually still working through this deal. We don't have everything finalized yet, and once we do, we'll be able to look at more of those details, see if this really is a great deal, but ideally this can be a good starting point. Anyways, that's all I've got for today, so if you like this video, please like it, since that would help the channel out a lot, and be sure to subscribe, since I put out new videos every single week about investing and personal finance, including quite a few videos about Bill Ackman and Pershing Square and Pershing Square Tontine Holdings as well. So if you like that sort of content, again, be sure to subscribe. But until next time, take care.